The Federal Reserve left interest rates unchanged. Markets responded by preparing for higher interest rates. Apparently, even doing nothing has become hawkish. The reason was not the headline decision. It was the 9-3 vote behind it. The Fed kept its target range at 3.50% to 3.75%. But Beth Hammack, Neil Kashkari, and Lori Logan all preferred a quarter-point hike. The button said, "Hold." 3 voters apparently read it as a suggestion. That does not mean a September hike is guaranteed, but it tells investors that the internal pressure to tighten policy is real. The market reaction was more complicated than a simple sell-off. Short-term Treasury yields initially fell because the Fed did not hike immediately, while the 10-year yield was still up roughly 4 basis points on the day at about 4.64% shortly after the decision. The dollar weakened, and stocks briefly paired losses after the announcement. In other words, Wall Street felt relief about today and remained nervous about tomorrow. Oil made that nervousness harder to ignore. Brent crude jumped 7.3% and settled above $88 as geopolitical risk returned, while the Fed itself said energy-related supply shocks were helping keep inflation elevated. Higher rates cannot produce more barrels of oil, which is an inconvenient detail for anyone hoping monetary policy can repair a supply shock with a press conference. But persistent energy inflation can still push the Fed toward tighter policy by threatening broader prices and inflation expectations. This is the pause that behaves like a hike. If long-term yields remain elevated, the discount rate on future corporate earnings stays higher, financing becomes more expensive, and liquidity-sensitive assets receive less room for imagination. That matters for expensive technology stocks, and it matters for Bitcoin because both depend heavily on risk appetite and the marginal price of money. Still, Wednesday's stock decline cannot be blamed on the Fed alone. The S&P 500 fell 1.5%, but AI shares were already under pressure and oil was delivering a separate macro shock. The next test arrives with the advance estimate of second quarter GDP and the June Personal Income and Spending Report at 8:30 a.m. Eastern Time. Those releases will test both the growth side and the inflation side of the Fed's problem. A softer inflation picture, falling oil, and lower Treasury yields would weaken the hawkish interpretation. Sticky inflation, resilient growth, or another rise in energy prices would strengthen the case that September remains live. The calm verdict is simple. The policy rate did not move, but the market's reaction function did. The button said, "Hold." Financial conditions read higher.